How do I know if I'm getting good investment performance or bad or average? Well, the answer to that question is, what are you measuring yourself against, right? A lot of us are looking at our portfolios, especially during this downtime, which is pretty common to do. And you're thinking, wow, that's not good. But in order to really understand, is it good, bad, or indifferent, what's that relative to? And in order to decide that, you have to know, well, what am I measuring that against? That's called a benchmark. So what's the benchmark that I'm using? There are lots and lots of benchmarks out there. There are lots of indexes that you hear about on the radio and some that you don't. I'm going to go over some of the most common ones and then talk about how you should be applying them or not. So like the first major one that I want to address is the Dow Jones Industrial Average. It's also just called the Dow. It's an index of only 30 stocks. It's 30 blue chip stocks, which blue chips are basically mega companies that are traded on the New York Stock Exchange that have been around for a long time. Some of them pay dividends, some of them don't, but they're huge companies and they're really stable. So that's what that blue chip thing means. So it's only 30 stocks and it's price weighted. And so that number gets really big and we watch that. Another one is the S&P 500. You'll also just hear that referred to as the S&P. Well, S&P is Standard & Poor's. They actually have lots of indices. The S&P 500 is just the most commonly thought of one. That is the 500 biggest companies in the US. And that is a market cap weighted index. Market cap weighted means the size of the company in that ranking of 500 determines how much of that index it gets. It's actually really a more valid measure than the Dow is, but that Dow's a big number and we've been using that number since 1896 when that index was first invented, so you hear that a lot. The S&P came along in 1957 and it's a much better index of kind of the overall stock market. But again, it's only 500 companies and it's only the biggest companies. So it doesn't cover small caps at all. Another one, for instance, if you are not investing in stocks, but if you're investing in bonds, there's the Bloomberg Barclays Aggregate Bond Index. It's also just called the AG sometimes. And I'll read you a little description on that one. It includes government securities, mortgage-backed securities, asset-backed securities, and corporate securities. And it's meant to simulate the universe of bonds that are available within the United States. And when I say that, I mean the universe of investment grade bonds. So it's not talking about high yield bonds, okay? So companies that are out there that don't have the best credit rating, they pay higher interest. This doesn't really cover those. That's kind of a different asset class. So which is the right index for me to use to look at my portfolio? Well, in order to know that, you have to understand what you're invested in. So here's some questions for you. Do I have international in my portfolio or am I only in the US? Do I have equities? Do I have bonds? Do I have both? Do I have some kinds of alternatives in my portfolio? Do I have real estate or commodities or some kind of hedge fund or something else in my portfolio? All those things have a weighing in on how your investments are going to perform and what you're going to benchmark yourself against, right? The other thing you have to think about is what's your risk level? For instance, if you were an ultra-conservative investor and 70% of your portfolio is going to be in bonds and fixed income kind of investments, it wouldn't make sense to use something like the S&P 500, which is large cap stocks, to measure your performance because you're not even in that market. So you need to find what's the appropriate benchmark for what is your investment strategy. So the things that I'd like you to ask yourself are, first, do I understand what is my expectation of good performance? And to understand what is good performance, you need to know, well, what's the measuring stick that I'm looking at, right? If I want to know my performance is good, I'm always in the back of my mind thinking, well, that's relative to what? And that goes back to the benchmarks that I was just talking about. Second thing you need to know is, what is my investment strategy? What the heck am I invested in? Do I have international? Do I have domestic only? Do I have both? Do I have stocks? Do I have bonds? Do I have other stuff? Is it all a mix? And where's it going? What am I expecting it to do for me? And then the third key to that is, do those two things fit each other? You know, if you're going to be looking at the S&P 500 and comparing your portfolio to that, but you don't have any S&P stuff in your portfolio, those two things don't match. And that's not going to work, and that's only going to be frustrating. So ask yourself this: if you have an advisor, does that advisor have the heart of a teacher? And is that advisor making sure that you actually understand your investment strategy, that you're on board with that investment strategy, that that strategy is getting you to where you want to go? Because not everybody's strategy is the same fit. That's why there are so many types of funds and stocks and bonds and all of that out there. So are you in a strategy, one, that you understand, and two, that is going to meet the goals that you're looking for? And then does your investment advisor understand, well, what's your risk level? And can they articulate that to you? I mean, the key is that you walk out of his office and you can say, yes, I know how I'm invested. I know what my risk level is. I know what those guys are doing for me. And consequently, I know what benchmarks I should be measuring their performance against. So that last question is just, does your advisor make sure that your strategy and your expectations around benchmarks fit and that you understand what all those benchmarks are, right? Now look, markets go up, markets go down. Markets have gone down. We are off of our lows for the year. Hopefully we stay there. It's a volatile time, but we've had lots of volatile times. Markets come back. So as markets go up and down, your investments go up and down. You should expect that. If you're in the market, that's just part of it. Ultimately, obviously, we want our markets to go up. But the big takeaway that I want you guys to take, and I'm going to read this for you here, is not only should your advisor provide you confidence in your financial life, but in the end, you should do better, even after you pay your advisor, than you would have done on your own. That's what we do here at Goodwin Investment Advisory. I'm Joe Beckford. Thanks for taking the time to watch.